Good morning, everyone. First of all, it is a great pleasure and honor to be here with you in Bologna, this beautiful city, and here with Prometeia. People belonging to my generation who studied economics and econometrics in Italy first and then abroad, we have always believed Prometeia to be a legend, a myth. Since 1977, when I first entered the university classrooms of Pennsylvania, and here Lawrence Klein and the other university professors, and Klein would be a Nobel Prize 2 years later on, and he would say that econometrics and economics would be really studied in one single place in Bologna University and in Prometeia. So that's what we've done. That's what we're doing in terms of scientific research. And really, my congratulations to Prometeia for its 40 years of activity and for everything that has been done to push knowledge frontier forward in terms of economics and econometrics. But now let's leave the enchanted mountain of pure science down to the misty valleys of corporate budgets and balance sheets and deal with banking supervision at a European level, which will make the object of my presentation today. And during my presentation, I will do my best and try and speak very briefly in the time that has been allotted to me about these issues. First of all, what is the present situation? Where do we stand in terms of the implementation of the banking union in general and in terms of banking supervision? What has been done and what is still being done in this field? A few comments will be shared with the objectives that have already been achieved, that are quite significant. And then we will talk about challenges and risks in the banking sector and what we are doing to address these challenges. And then I will switch to the policy implemented by European Supervision Authority in cooperation with the national supervision authorities. And then briefly, I will reach a few conclusions. After the crisis, many things have changed at the national and European level, especially with reference to the legal and regulatory framework of banking policies in general and banking supervision in particular. Since 2013, a new banking legislation was introduced at a European level, which is the Directive on capital requirements and regulation of capital requirements. This is a very important aspect which is sometimes underestimated. Supervision doesn't really have an endless and discretionary, arbitrary power to take action on banks. A supervisory authority has to take action within the regulatory legislative framework. Otherwise, many risks are incurred in too. So from many points of view, banking supervision is both good and just as good as the underlying law that has to be enforced by it. This is a very important point. As for the setting up of these European juridical bodies that are still incomplete, still evolving, and so we have to use these frameworks in combination with the national legislation, which makes things a bit more difficult because it really jeopardizes the equal opportunities between various countries from certain points of view. And then, of course, we've got a single supervision since 2014, which is based in Frankfurt, and then a new legal framework concerning crisis management. Crisis Resolution Authority was set up in Brussels in 2015, and then in 2016 it became fully operational. We've got a resolution fund at a European level to fund resolution measures, but unfortunately, and that is a moot point that we should go back to, we don't have any area pan-European area deposit insurance, and it is very important for many reasons that we can discuss. The negotiation on deposit insurance has not reached any agreement yet, which is a lack, which is something which is not implemented yet. So the framework is quite comprehensive, even though a few pieces of this framework are still missing. What has been done so far? I don't want to talk about what we've done at the ECB level, because that has already been dealt with again and again. You know that you've got a supervisory board with the internal supervisory structure, which is quite very well working. A few years ago, I saw the ECB coming about as for the monetary economic policy, and please believe me that a high professionalism level was achieved very rapidly, beyond my expectations, when ECB was set up as for monetary policy. Of course, the Supervisory Board was introduced in a much stronger organization from a technical point of view. So the fact of having the Supervisory Board within the ECB was a winning and right choice. The heart of this system is the so-called joint supervisory teams. The national ECB supervisory teams that concentrate on each bank. They have the technical expertise, knowledge of each and every bank. Specific, detailed notions, expertise, contacts are necessary. This is the very heart of supervision. And then there are horizontal structures that make sure that all the teams work and according to common principles. And then on-site supervision. This is a very important part that has to be further developed by ECB. So it is up to the national authorities to act, and we participate from Frankfurt, but it is up to the national or supervisory boards that take action during site inspections. I like this slide, and I want to show it to you. As far as our methodology is concerned, this is the most important thing of all. It is the supervisory review and process. In economics, when you use an econometric model, you use a tool that puts together a whole set of information pieces together, and these various different pieces of information have to give rise to a consistent and complex framework. SREP is not an econometric model because it doesn't have the same quantification degree, but it plays the same function. It is a set of general criteria that are partially qualitative and partially quantitative that put all the available information together concerning the various banks and to boil them down in a scoring that determine the degree of reliability, quality, etc. 4 pillars have been identified. These 4 blue boxes that are very important to us: business model assessment, sustainability, the governance quality, which is upstream as for bank management, quality governance quality and related risks, risk management assessment, and then assessment of risks to capital and assessment of risks to liquidity and funding. So we will analyze these 4 boxes. We will assess them, and they will be put together in terms of numerical overall quantifications, and we get down to the decisional level. The quantitative capital measures, the second pillar, quantitative liquidity measures, and other types of supervisory measures that might be asked for also from a qualitative point of view that refer to governance, checks, etc. This is a kind of annual exercise which is done on every bank, and by the end of the year, the capital requirements are quantified. So this is the heart of our methodology. 2 more things. Now, In the regulatory legislative framework, the European law includes a whole set of options and flexibilities that would have been applied by the national supervisory boards in a different way before the European Supervisory Authority came into place, into force. So these options had to be applied in a consistent way in all the various countries. That was our role, and big negotiation efforts made sure that all the national authorities, boards that are part of a supervision system would agree on single criteria on how to apply flexibility criteria on the whole system. The second aspect that I would like to touch upon concerns the non-performing loans. And there we have realized that non-performing loans within the European system, which is supervised, are the main problem because of a whole set of reasons, and that required not just a routine supervision, but also a specific project to address this issue. How did we do that? We did it with an action plan, so to speak, with various steps. First of all, a survey of the situation concerning the various banks and concerning the best practices internationally to manage this issue. Then a few guidelines were identified in two directions, because banks are required to reply to two things: having corporate structures that would know and monitor the problem well. And in many cases, we realized that banks didn't have the necessary information. And in many cases, they didn't have any adequate, sufficient information to assess and monitor this problem, so internal structures. Secondly, banks are required to deliver plans. That is a very recent issue. Internal, realistic but ambitious plans should be put forward to absorb the non-performing loans by selling them on the market or managing them in a different way. I'm not talking about a stiff guidelines that are good for everyone, but on a case-by-case assessment based on bank proposals. One last thing before talking about the more specific problems, I would like to call your attention on the solvency level of the system that has increased substantially. These histograms refer to the period when we started supervision and really show for the various capital categories that capital quantity related to assets related to risks increase gradually and continuously over time until today. So the system is much more solvent, safe, robust than when we started supervision in Frankfurt. What about challenges now? First of all, profitability. Profitability entails many types of factors. Bank profitability dropped, and that creates problem for the bank's robustness. In red, you have the return on equity, which is at 5%, quite stagnant since 2014. It is too low because the capital cost is much higher than that. And so it is at an insufficient level also because of specific reasons. If we take the best performers, the best performing banks in blue at the top, these banks are much above, whereas there are other poor performers. So there is a big difference in the system. The best performers at around 10%, which is already a very good level, a quite satisfactory level are those banks that manage to keep costs down, that can control their costs better than the others. It is not a question of applying a different business model, opting for one activity rather than another one, retailing, wholesaling, credit-oriented, market-oriented activity. But the common issue among best performance is a better cost control capability, and then margins. Mainly European banks are retailers. They transform saving into deposits and loans. So margins do matter. Margins have become narrower, and that is true for all the countries. To the left, you've got the more vulnerable countries, and to the right, the other ones. But the reduction of margins has affected all the various countries, and this is one of the reasons why banks are suffering. What is the impact of monetary policy? Well, banks suffers because the ECB reduces rates and has caused that in a way or another. So an assessment, a quantitative and econometric assessment has been made, and so this is the result. This slide shows that the expansion monetary policy influences banks through different channels, and some of them affect the bank and some other encourage and favor them. So we should see what the balance is. The impact of interest margin rates is in red, negative. It has always been negative, but it varies from country to country. In Germany, it has been lower, and for Italy, it has been especially significant. On the positive side of this diagram, we can see that in yellow, the credit quality, which is more expansion policy, encourages economy and credit. So there is an improvement on this side, and there is also an improvement for other types of channels. The part in light blue, these are the capital gains, the portfolio assets that are assessed at the fair value, and whose value improves. So this balancing makes sure that the expansion monetary policy has favored banks in general terms. And now it is believed that we are almost at the reversal of the trend. So we need to see what happens when interest rates increase, and that should foster banks with a few risk factors that should not be forgotten. Now, very few words about these numbers. There are quite a few. I hope you can read this slide. Many numbers figures are on it. They refer to non-performing loans, the various measurements of non-performing loans and the cost ratio. Bank cost income ratio for each country and for the country within its national borders. So we need to have a look at the non-performing loan ratio that referred to the third quarter last year, 6.6%. And if we look at individual countries, there is a big difference. For example, Italy, we are at 16.1% as against 6.6%. And of course, we shouldn't forget about the provisions that differ from country to country and the coverage rate. For Italy, it is a bit higher than the average, 47% of non-performing loans are covered by provisions as against 45% as for the system. But even taking that into account, net non-performing loans, 3.6 for the system, is much lower as against the 8.5% for Italy. So even taking into account the bigger coverage rate, the problem remains. And then cost ratios. Cost-to-income ratio, we are at 65.2% as far as the system is concerned. As for Italy, it is a bit higher, 67%, a bit slightly higher. This is growing, by the way, in Italy. It didn't drop, but it is growing, and should be highlighted that in France, we are already at 68%, or in Germany, we are at 77%, so lights and shadows. But this table shows that as for non-performing loans, this is one of the major problems, not just for as far as Italy is concerned, but also as far as other countries are concerned as well.
Here you see the impact on non-performing loans. You see the countries that have been highly impacted by the crisis or less impacted by it. In blue, you see the overall number of countries that have been most affected by the financial crisis. In yellow, the other countries, and you see that basically the crisis has impacted quite heavily on them. So these two elements have got to be considered: the overall macroeconomic aspect that has created non-performing loans, and then there is the problem with each single bank. So we see that there are major differences amongst the different banks in Italy in terms of non-performing loans. This is due to specific factors that vary from bank to bank, and the authorities have got to concentrate basically on those aspects. These are the market risks relating to assets and liabilities evaluated not at the amortized cost but at their fair value. There are different market risk types. Here you see a split in three parts. These are exclusively the assets, but there are quite consistent liabilities too. Level 1, 2, and 3, based on the transparency level of the pricing. Level 1 is wherever you have an active market. Level 2, there is no such a market, but similar prices to compare with. And level 3, it's only when you have an internal bank model that can evaluate the risk. So these are always referred to the assets. It's a percentage compared to the total assets for the entire period you see indicated under the columns. Under the majority of level 1, of course, there are market risks in those cases too, but they can be easily measured. Then we have level 2, the intermediate area, which is quite remarkable, but there is a quite high degree of reliability as compared to level 3, which is a real problem. So that's very hard to evaluate, but actually these are small amounts at the system level, but they are fairly concentrated at certain banks. As far as level 3 is concerned, we have small countries, big countries, countries from a certain geographic area. They're not concentrated within certain banks and within certain countries as one may think. So this is the overall picture concerning the market risks. And in a minute, I will show you how we monitor them and how they should be monitored by the supervisory bodies. So all risks are compared, and in order to show what the credit risk is versus the market risk. You see the column of the euro area, the first column. These are the weighted activities, and the credit risk at the system level, at the entire system level, are much bigger than all the other risks. These are the market risks, these are the operating risks that are quite consistent ones. And if we take a look at them as weighted activities, no doubt that the credit risk is the major risk to our system. And this is the element we'd like to stress. And that's why we're devoting so much attention to such problems. So, supervisory responses, how are we treating and considering these risks? Profitability challenges, well, of course, it's a cyclical problem. It's a matter of choosing the business model, but also it relates to the cost evaluation. We have evaluated the risk models and the profitability elements. We have derived there from some soft guidelines, relatively soft guidelines for the banks. We do not believe that the supervisory authority should impose a business model. These are companies that are listed. Many of them are listed at the stock exchange, not all of them, and their managers decide over the activities that the bank would like to carry out. We can solely confine ourselves to considering the solidity of a certain bank, but we cannot impose upon the banks the business model they should have, which translates, of course, into certain guidelines that are not so severe for them or that are not binding. Now, normalization of the interest rate cycle. We will have a new stress test this year on top of the one we made last year. So the European Central Bank should have conducted a stress test this year because this takes place once in 2 years, and we will be focusing on the risks for the current year. This is the stress test result from last year to see how the market risk and credit risk can be compared. This was the last stress test from last year. In blue, you see the baseline, and then the adverse scenario, and then we compare the two. In 2016, you see the baseline in blue on the left-hand side, and then the adverse scenario in yellow. You can tell the impact that the market risk has had, which was much greater than the credit risk. You see, that's the difference between those. But the stress test doesn't tell you the whole story for a series of reasons. It enables you, in any case, to evaluate the size of the market risk as well as the credit risk. Now, obviously, market risks are more persistent over time. Whenever there's a market shock, one believes that there will be a faster return to the average, whereas you would think that in the other case the effect would be more persistent. This is to show you what we're doing for credit risk. We are drafting a guidelines. We have just drafted the guidelines concerning non-performing loans and credit risks. The press has reported on it. We provide guidance and guidelines. We would like to have internal guidelines and realistic plans to be drafted by the banks so that they tell us what they can realistically do. As far as the market risks are concerned, in order to evaluate especially activities that have no market, you have to take a look at the internal models of the banks, because there are many of them and they're very complicated. So you have to go on site for an inspection, and the teams have got to review all the models. The law gives the bank the possibility to utilize such models to evaluate the risk level. So they can be utilized, but they've got to be up to an adequate quality level. This is what the supervisory body has to do. And this TRIM, the target review of internal models, is very important. So these internal models have got to be up to their function, and we have started this activity last year. We'll probably finish off at the end of next year. We'll review all the bank risk internal models. And it's not something you can resolve in a matter of no time, but we're devoting a lot of attention to it, and on top of ad hoc inspections on site, as well as targeted analysis of various types. And I'd like to conclude by saying that ECB supervision has been set up rather quickly but successfully. It is a well-functioning tool in spite of all the problems there might be, because we're still in a learning process. But in any case, it is working appropriately. There has been a clear-cut regime change. There has been a change in equality of treatment and rigorous supervisory activities in all countries. We are conducting ongoing supervisory activities, and the NPLs are a major challenge to the system, but we're monitoring them very closely. Then there are very important issues that I mentioned to you, and we know that in Europe and in some countries in Europe there is an excessive bank presence or overbanking, which requires restructuring or other measures, which is a trend that is already ongoing in many countries, also in Italy and Germany. So the number of banks are being reduced gradually, and the number of branch offices are also being reduced. Cost structures are being monitored very closely, and then the technological issues still very important in the medium term. But this medium term is going to happen very soon. Thank you very much.